So a quick recap on the calculation of the profit before tax. You start with your accumulated profit at the end of the year, which happens to be 68,000 in this case, 68. The opening accumulated profit is 24, and therefore the profit after tax for the year is 44. Now, had the cash flow statement said start with profit after tax, I would have been quite happy with 44. But of course it doesn't say that, does it? It says profit before tax. So what do? Just add back the tax. And so that's very, very simple indeed. That's 50. Now, quick check of the question, see if there's any more movement that one needs to worry about. I think most of the time one is able to just compare the opening to the closing and work out the difference. For example, the cost has gone up by 40, the depreciation has gone up by 14, etc. We can more or less do that in our heads without doing too many more workings. So it seems like a good moment to begin to do the cash flow statement itself. So let's turn back to where we were a few minutes ago as we began our format itself. So let's go back a few pages. We've got a little footnote there, lots of information towards the end. But what we need to do is to go back to the start of the cash flow statement. Here we are, statement of cash flow for the year ended, etc. So, do you remember the format? You've memorized the format, of course. You start with profit before tax. So maybe let's start even before that with the descriptions like cash flow from operating activities. Cash flow from operating activities. The couple of headings may be ideal. A bit to the left you have dollar signs, thousands. A bit to the right. I'm going to concentrate on the one on the left to start with. So we start with profit before tax. So let's say profit before tax. A figure of 50. How is that? Well, we did a big working a few minutes ago. So that's our first item in place. To that, of course, we add our adjustments. So I say literally adjustments for. You will recall things like depreciation. So in this particular case, you have depreciation for the year. Now you remember the depreciation straight from the question, 92 at the end, 78 at the start, must have charged 14 this year. There are no interest expenses and things to worry about, which is why earlier I explained to you that it was very important to master those things, even though they do not feature in every question. It could be just the one that comes up in the exam that has that in it. So be careful. So there, if you add that up, I believe that is 64. That's neat. Nothing to worry about as we move on. That 64, I suppose I could describe as operating profit before working capital changes. So let's say exactly that. Operating profit before working capital changes, 64. Below that, of course, you have the working capital changes. That little section. This is where you have to be really careful. Easy marks, though, if you're careful. As far as I can tell, we have inventory of 17 at the year end, and at the start you had 12, so it's gone up by 5. So once I've decided it is an increase, in other words, if I check to see if it is an increase, once I've decided in my mind it is an increase, 17 compared to 12, I'll then actually use the word increase. So let's say increase in inventory. Don't worry about brackets near the word increase and so on, but where brackets do matter is if you feel it's an outflow on the right. So let's say 17 minus 12. So in the column a bit to the left, I'm going to say 5 in brackets. And obviously, to explain that, one should be saying we simply bought more inventory, paying by cash. So we bought more inventory paying by cash. Always assume it's cash. Now these are just my explanations. You don't need to put them down in an exam question, just for you to understand as we do these things in class. Okay, increase in inventory, not a problem. Let's see what's happened to our receivables. That also has gone up, this time by 8. So I'm confident to use the word increase in receivables. Increase in receivables, 10 minus 2 equals 8. What that means quite simply is I lost cash because I failed to collect. So let's bring that in. We, Radiance, failed to collect, lost the opportunity, therefore lost the opportunity to get more cash, for more cash, something like that. Okay, so these are just some words in class I'm using to explain to you how it all works. In case you're asked to write about it, of course, to see whether I can deepen your understanding. What else do we have? The bonds and cash you must keep away from, because that, of course, is the overall movement. So you mustn't duplicate by bringing that in. For example, you mustn't say that you might have bought some more bonds or whatever. In this case, of course, it doesn't change, but if in case it does, you mustn't go down that route. Bonds and cash are all part of the cash situation. Indeed, if you had an overdraft, that would have reduced the cash. Okay, so overdrafts are meant to be a minus. All right, nothing much there with current assets. If you pick up your current liabilities, I notice the payables are down by 6. Careful. So this time there's a decrease. Don't worry about putting brackets around the word decrease and so on. Just say decrease in payables, in trade payables. From 19, it's gone down to 13. So that is 6, bracketed, I suppose. Decrease in payables simply means you pay them off. So we paid them off. Hence the use of brackets. Had it been an increase in payables, they financed us. It's a cheap source of finance, so obviously our cash has been saved. This time, of course, it's the other way around. We've paid them off, so we've lost cash, hence the use of brackets, outflows. So brackets are outflows, no brackets are inflows. That's all cash flow statements are. As far as these items on the far left are concerned, it's just a good gesture The very best students always do that. They explain to the marker exactly how these various items are arrived at. So just a little bracketed minus, plus, or whatever gets the marker over onto your side. If you were doing a more serious exam, of course, because it's computer-based these days, you can get away with doing very little. But the other reason I'm doing it is it just improves your own understanding, gets your confidence level up. Right, so how are we doing with all this? If we were to add it up, you'll find yourself with 45. That 45, which is 64, take away 5. 5 and 8, 13, and 6, 19. 19 away from 64, of course, is 45. So we're on the right tracks. The 45, of course, is cash generated from operations. Cash generated from operating activities, operations. What else do we have? Obviously, if we have any interest paid, it'll be shown. If you haven't got any, it will not be shown. And then you've got your tax paid. This might require a bit of a working, because I notice there's a little bit of activity round about the tax area. For example, last year we had a tax balance of 1 to be paid. This year a tax balance of 3 to be paid. And yet during the current year 6,000 has been charged to income statement. Now that's quite risky, I would say. So because of the risk factor, may I suggest that you do a little working. So abandon these 2 pages, go off to your workings page, which is back here somewhere. And once we've done our profit before tax, the next item, of course, will be the tax itself. So let's call this working, whatever it is, working 2 maybe. If I did call that working 1. The overall cash movement, probably don't number that working at all. So calculation of profit before tax is working 1. This is working 2. This is the tax summary. So, tax summary account. Bring in all the tax information you can find into this T account. So here we are, a little T account. Make that a good 6-8 lines long in case there's something there. Debit, credit. The figures are quite small as it happens, especially if you knock out the zeros, the thousands. The opening on 1107, opening balance brought down is 1. Leaving 2-3 lines, we find that at 31st December 07, the closing balance carried down is 3. The charge for the year, which should be on this side, the income statement charge for the year, should be given in the question, of course, just below your statement of financial position, is 6. So if I add up the heavier side, put it onto the lighter side, and the difference between whatever the lighter side has and the figure we now have is obviously the cash paid. So here I'm going to say, therefore, cash paid, which must be some kind of outflow, equals, as you'd imagine, 4. So that is the cash paid, the 4. So 1 plus 6 is 7. 7 on this side. You put this 7 onto this side like we normally do. And then we work backwards like that. It becomes a balancing figure of 4. So a little bit complex, I think. Not so bad where there's only a couple of opening balances and one income statement charge. So it's a debit to income statement and obviously credit here. Now, I just want you to open your mind to the possibility of doing these things without too many T accounts. So rather than saying opening, closing balances, just we'll reason through it. Okay, do consider this for 5 minutes, please. A special request from me to you. So or can be done like this. If you remember when I did my calculation of profit before tax, I kept away from too many T accounts. I used a reasoning style. And that's exactly what I'm going to be doing here, though I'll be a little bit more careful because tax can change. It is changing all the time. So your opening is 1. To that, I'm going to add the income statement charge for the year, which is 6. And so that's 7. The opening has become 7. Obviously, if you have opening of 1 and you have tax of 6 for the year, the opening has become 7. But closing is given as 3. So how is it that the opening of 7 has only become 3? 4 must have been paid. So that's an outflow. You see that? No brackets, not too many brackets, just reasoning. Therefore, cash paid, which is obviously the tax paid, equals 4. So what do you think of that method, honestly? Do you see the great advantage is that you get your figure very quickly, especially if you're just sitting in front of a computer or a computer-based exam, let's suppose. You've got your opening, you've got your charge for the year. The opening has become 7. How come the closing is only 3? Well, we must have paid 4. You see, it frees you up from thinking about whether it's on the debit side or credit side, etc. If you've got T accounts, of course, it becomes a bit, puts you in a bit of a straitjacket. If you're not familiar with it, or if you have a blind spot on the day of the exam, you'll find it quite hard to get that figure of 4. So notice no worries about which side of the account, no worries about whether it's a debit, credit, what happened to the income statement, etc. Here you're just using logic. And because it's a cash paid item, of course, it's outflow. So do consider this free of T accounts method. The main reason I request you consider it, well, you can stick with T accounts, no problem. The main reason why I say please consider it is when you come up to doing F7, hopefully with me, I'll show you where the questions get much more complex. The only way it can be done is by using reasoning, focusing on inflow, outflow, rather than T accounts. I don't want the examiner to know I'm a very good bookkeeper. That is assumed. What he would like to see at that level, or even at the lower level, the lady examiner we have, she wants to see that you understand cash flows rather than be able to do necessarily demonstrate bookkeeping skills. So that's one reason when you come up to F7 financial reporting. If you move on a little bit from there, 6 months, a year later, you'll be doing something called P2, which is corporate reporting. In that, you'll have to deal with groups of companies being bought and sold, and foreign currency and pensions and that kind of thing, through the eyes of cash flows. And in that instant, the lecturer, whoever it is, whether it's me or anyone else, will request you not to do T accounts on the grounds that it just overcomplicates the whole issue. And the problem then becomes not so much the question itself, but the method you're using to solve it, which is, of course, the T account. So I tend to do cash flows without T accounts because all I need to do really is to get an inflow or an outflow. And if you come back once more to F3, which is our level, all the examiner wants to know is it an outflow? Is it an inflow? Do you know which one it is? Do you know how much it is? He or she, examiner, whatever level, not interested, of course, in the mechanics of your bookkeeping. What is the figure? And I think that sort of method where you have opening has become closing, and so on, seems to flow quite nicely. Do consider it. This is a small private request. All right, otherwise I think we might be able to sort out our tax paid figure, which is naturally in our cash flow statement. So let me break back. So if you turn back, please, to the first page, we should have a nice little slot there for tax paid. Here we are. The cash paid, I believe, in this question is a figure we worked out just now, 4. So let's bring in 4 as a deduction. And so the running total is 41. So net cash from operating activities. If you have got that as your end of the first page, I'd advise starting your next page with that figure. Fortunately, on the screen here, I have a never-ending electronic page, or virtually never-ending, so I'm a little bit better off. But if you're using a sheet, maybe as you practice, perhaps just make that, mention that right at the top, especially if you're doing it very fast in the exam in front of a computer. You must feel comfortable about all these running totals. Right, so that's under control. Let's go for the next one. Cash flows from investing activities. So we've done our operating, we're now doing investing. And then in a few minutes, no doubt, we'll have financing. As far as I can see, the investing is quite a quiet category in this particular question. All that's happened is that you bought some non-current assets. So we're going to say purchase of non-current assets. 220 at the year end, 180 at the start, must have bought 40. So that 40 I shall show here, perhaps bracketed. And so 40 appears lower down as the subtotal of my cash used in operating activities. So lower down here I'm going to say net cash used. They use the word used where it's negative. Used in investing activities. $40. Just move it down slightly. No problem. And so, because we've got our operating 41 and our investing of 40, nearly cancelling each other out as it happens, we've got to bring into play our cash flow from financing finally. Cash flows from financing activities. Clearly we had an issue of shares. Different ways you can approach this, I suppose. The opening shares, you can see in the question, the opening share capital has gone up by 20 to closing, and the share premium has gone up by 2 from opening to closing. So you can either do a working, or you can just use common sense and put it together on the face of your cash flow statement. That's perfectly acceptable. So let's have proceeds from issue of shares. Now be careful. The ordinary share capital is 65 minus 45. I'm going to call that 20 new shares. The share premium, SP, we've come across that in recent sessions quite a bit, is 12 minus 10, and so that's 2. So if you add that up, that's 22. That represents proceeds, i.e. inflow of cash of 22. Okay, so that 22 I would like to show on the right. Please ignore that line. So that 22 I'll show a little bit to the right if possible, not quite to the far right. And then you remember there were some loans repaid, repayment of loans. The loans were 30, now are 20. That is to say, the opening has become closing of only 20, indicating presumably 10 were paid off this year. And if 10 were paid off and 22 upstairs was an inflow, proceeds coming in, we are going to net them off and argue that this is 12. That 12, of course, is the net cash flow from financing activities. So let's write that in. Net cash flow from financing activities. And needless to say, if you added that up, I've given myself probably a little bit too much room. If you come down the page to say this sort of area, we should be in business. Let's have a look. If you were to add it all up, remember we had 41 as our inflow of cash from operating, 40 as our outflow of cash from investing because we bought some plant and buildings and so on. So we've got a net of 1. The 1 plus the 12 we did just now comes obviously to the 13, and so it all adds up to 13. And of course at the start of the year there was 13. This year we had 13. 13 and 13 of course is 26. So I've given myself a couple of extra bits there, which just in case the question was, it's better to have too much rather than too little space. So a very, very simple exercise indeed. What do you think? Seems like we must memorize the format. We must think of some points where cash flows are superior to income statements, things like free of bias, creative accounting, etc. What else do we need to know? Must memorize the format. Apart from the format, there are some typical workings for tax, for the retained profits, accumulated profits for the year. How does that relate to profit before tax? That's quite useful. Indeed, the odd little T account may be, but if you can lift your understanding by keeping away from T accounts and just reasoning through it, that is faster, number one. The other thing, of course, is more accurate. And the third thing, it shows the examiner, if he or she was looking at your workings, that you understand what you're doing. Of course, that's quite important as well. So those are the ways of mastering this cash flow statement. You know the format, you know some typical workings, just do as many questions as you can. That's a huge comprehensive question. You probably get more value by rereading the format. So what I could do perhaps is just take you back to the format for a few minutes to show you what this question didn't cover and what an examination question might. So if I take you back perhaps to the format itself to take you through some of these additional points. Here we are. So memorize format. Statement of cash flow for the year ended. It's like a statement of comprehensive income, statement of changes in equity. It's for the year, unlike a balance sheet SFP, which is as at. So from operating activities, OIF, 3 categories, operating the first. You start with profit before tax. You adjust for things like interest expense, depreciation, loss on disposal, selling non-current assets. Do the opposite of what you do in the income statement. That word opposite is absolutely crucial. So there you are. Once you do that, whatever was done in the income statement has now been cancelled, negated. So you have a clean slate on which to start. You then have your working capital changes. Don't forget that if you have an increase in inventory, you bought some more, you've lost cash. If you have a decrease in inventory, you've sold some, you've got cash. And so it goes on. Increase, decrease in receivables. Clearly, if you have an increase in receivables, it means you have failed to collect, and so you've lost cash. If there's a decrease, you've converted your receivables into cash. This is so simple. If you have payables and there's an increase, it means you have saved cash because they have financed you. They've allowed you to keep your cash for a bit longer and perhaps pay them much later. They've given you that freedom. So therefore, an increase in payables is actually an inflow of cash because we've saved cash. Equally, if we paid them off, there's a decrease in payables, so obviously that is an outflow. So that's very easy. I find that section very easy. What you must do, however, is try to understand that little bit. If she challenges you with a 2-mark exercise with a few of these increase, decreases, how good are you? Can you do them every time with brackets where it's an outflow, no brackets where it's an inflow? That really is a challenge. What else? Cash generated from operations, interest paid, tax paid, any special workings, of course, if necessary. So that's your operating activities done. The pro forma continued. Net cash from operating activities is, of course, what is brought forward. We're now moving into the investing section. The investing, of course, buying and selling non-current assets. You must go for the proceeds, not the profit, where you're selling, because obviously the profit was adjusted in the early part of the operating activities, where you did the opposite of what was done in the income statement. Remember that? Interest received, dividends received. Just be careful of the word received. That should exclude any adjustments like opening and closing accruals and pre-receipts and prepayments and so on. All right, and then you have your financing activities. So if money comes in, you call it from. If it goes out, you call it used in. Here we have some financing activities. You've got some shares, cash from issuing shares, including a premium, receipt of loans, of course, repayment of loans, and then any dividend paid. There's some flexibility with the dividend paid. They do allow you to show it earlier under the operating if you wish. But this is quite popular, this method, financing, as long as it's there somewhere. The other way to get easy marks, of course, is to check out the overall movement of cash and slot that into the bottom of your cash flow statement, even as you start the question within the first few minutes. It's the only topic that has that available to you. Okay, so that's the one look at cash flows. There is one other kind of cash flow question which I want to interest you in, and that is, as I'll show you in a minute, demonstrated there as example 2. Now, there's something called the indirect method, the method I showed you, the most popular method, and naturally there's another one called the direct, and it is to that we now turn our attention as our last few minutes on cash flow statements. The direct method. The direct method involves adding together the cash flows, inflows, and deducting the cash outflows. It's as easy as that. They might give you some workings. For example, cash sales may be dependent on a little calculation, as we'll see on our next topic, called incomplete records. How you actually work out things like amounts received from customers, for example. Cash sales wouldn't be so bad. She should give it to you directly. However, we're doing cash flows here. So if you've got some cash sales, cash received from customers, cash purchases, cash paid to suppliers. So when it says cash purchases, what it means is you bought something for cash. Whereas what it means when it says cash paid to suppliers is people who sold you goods on credit, how you pay them off. So it's slightly different to cash purchases. And then you have cash expenses, cash wages and salaries, etc. Very, very straightforward. Nothing to be afraid of. Calculate the cash generated for this company called Empress Limited. So let's go off and look at the answer direct to save you a bit of time. Solution. Cash sales. You remember from the previous question, that is 55, and the cash received from customers is 44. So I'm going to do a nice big inflows here. Do you agree these are inflows? Whereas the one down here, outflows, inflows and outflows. The inflows, cash sales and cash received from customers. So the total cash received is 99,000. This is all to do with operating. By the way, this is only operating activities. The investing and financing is in any case direct. Okay, it's just the operating that is in any way changed by this direct word. Cash purchases as given, 33,000, 12,000, 11 and 20 respectively for the cash paid to suppliers, cash expenses, cash wages and salaries. Notice the word cash everywhere. And so you bring it in directly as 76. And of course the difference between the two is what we call cash generated, net inflows. I need to just say that you need to master these two examples, particularly the first one, and of course read the format because that has more in it than the question itself. So I better just say this is from operations, and the other point I ought to make is for operating, what's the other one? Investing, and the other one? Right, financing. For investing, and financing, normal approach is fine. So investing and financing, the normal statement of cash flow approach, layout, etc., identical between indirect, which is normal, and direct, which is special, or just special for operating activities only. So let's make that clear. For the word indirect, which is the normal method, everything is exactly the same. Except when you're doing your operating. So this is change affects operating activities only. Affects operating activities only. The investing and financing is exactly the same between indirect and direct. So nothing to worry about, please. Very straightforward indeed. So there you are, a lovely topic. What I would suggest you do is, on a blank sheet of paper privately, stop the tape now, see if you can write out the entire cash flow statement format on an absolute blank sheet of paper. Indeed, you must practice that technique on things like your statement of comprehensive income, the income statement, on your CSF, statement of financial position, SCF's financial position, etc. That's very important indeed. So for your SFP, for your SCI and your SCF, statement of cash flows, you must be able to write on a blank sheet of paper what the format is. Otherwise, you'll be struggling with a big question if you were ever asked, because little bits of it come up, and so the examiner, Nicola Ventris, assumes that you are really, really familiar with all those little bits and pieces. So otherwise, you can see our progression. We did some basic sole trader type accounts, where we did lots of little T accounts. We then started doing some journal entries. We did our trial balance. We then adjusted the trial balance with a few more journal entries. We then came across the adjustments, the key adjustments like inventory, depreciation, revaluations, bad debts, etc., etc. We then began to do the three big topics like control accounts, like correction of errors and suspense accounts, and of course bank reconciliation statements. Those are the big three. We're now moving into things like the limited company accounts, cash flows, and yet to come are things like incomplete records and partnerships. And that should take us to the end of our huge but quite easy syllabus.